Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Laurent Laskowski, derivative strategist at Mizuho Americas, to discuss why the use of derivatives will continue to grow as investors continue to look for alternative ways to hedge their portfolios against market risk in the wake of closer correlated equity and fixed income markets, high inflation, and of course the uncertainty with the Fed. Laurent, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me, Jill.
Give us some background on the U.S. derivatives market. How big is it, and why do investors use them?
Right. So 2021 was a record year for options trading. In fact, the OCC reported about 9.9 billion contracts traded. That's 32% more than what we had in 2020. That's twice as many as 10 years ago and 10 times as many as 20 years ago. So the adoption of options, has really grown, and now options are no longer used by institutional investors and specialists, but are also used by retail investors as well. And really, people go to options to go beyond just buying and selling stocks for all the flexibility that option strategies offer. Just asymmetries, the ability to hedge downside risk in their portfolios, or the possibility to add additional income in a portfolio as well.
So when you think about what's fueling the rise in retail and institutional investors using derivatives in the US, it really comes back to optionality and being able to hedge portfolios or speculate in another way besides just buying or selling the underlying.
Right, definitely taking advantage of these asymmetries and risk management. We saw it last year, right, with these big short squeezes. So in this case, rather than just being short a stock and being exposed to, say, unlimited downside, should you have a squeeze, investors may want to look at put spread strategies to limit their risk there, for instance.
Let's talk about some of those themes. What were the themes that drove derivatives markets in 2021, and what do you expect will drive them in 2022?
Sure. So 2021 was really, again, a big year for options trading. And I think the big theme in 2021 was how important options activity was and options activity's influence on the market was. So really now, investors need to take a look at options activity, even if they do not use options in their trading, to see how options can affect the market. We saw that, for instance, in the meme stock, of course, with a heavy activity in short-term calls would just trigger exacerbated rallies in these heavily shorted names like GameStop and AMC. But we also saw very large options activity used by big institutional hedging programs, just selling calls and to purchase puts and put spreads on indices to hedge. And these calls and these puts and put spreads are so large that they also have an influence on the price action of at the index level.
Are derivatives appropriate for all investors, and can they be incorporated as an investment strategy in balanced portfolios?
Sure. So, look, derivatives contain a lot of risks and are not appropriate for all investors. Overall, investors really need to get first well-educated, understand the risk of derivatives, and then once they really understand the risk and do not take inconsiderate risks in their management of them, use them for their portfolio for diversification of strategies, hedging, income generation as well.
And Laurent, to wrap up here, what are your top derivative picks or strategies as we go through 2022?
Right. So in 2022, we're still expecting, this short-term activity, these short-term options being traded heavily. We're still expecting these big hedging programs to be here. Now, the big difference in 2022 is, of course, the stance of the Fed, a Fed that is no longer accommodative, a Fed that potentially is going to raise rates as much as 4 times this year, and a potential runoff of the balance sheet later this year. So in this environment, we're expecting investors to look more for income-oriented strategies, selling calls on their holdings to harvest call premium and thereby generating income, but also being more wary of the downside here, as bonds are going to come under pressure this year and may not provide this diversification that they did in the past in bond equity portfolios. So here at this stage, we're expecting a choppy market in the beginning of 2022. We would like to look at downside protection, particularly in growth stocks and in the Nasdaq, for instance. In the Nasdaq ETF, people can buy puts or put spreads. On the upside, we're bullish energy here because of strong supply-demand dynamics that are still very bullish for the price of crude oil. But here, so far this year, we're not even in mid-Jan, and the XLE, the energy sector ETF, is already up about 13-14%. So to continue to bet bullishly on energy, we would rather go with calls and call spreads in XLE rather than going in XLE directly.
All right. Laurent, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.